Everyone, welcome back to Consistent Profits. This time around, we're looking at smart money concepts that can transform your trading for days. If you haven't subscribed to the channel, please do so right away. And without wasting time, let's look at these concepts. Okay, before we continue, shout out to ICT. Without his teachings, I would have not probably understood these concepts like I do right now. Shout out to the man. Awesome. Now that we got that out of the way, before me, I have the order block. The order block is the number one concept that you need to study and understand if you're going to become a profitable trader. So let's have a look. How would that look like in the charts? All right, before me, I have GBP USD, and this is what we call an order block. The reason why we call it an order block, we understand that it is the last bullish candle ahead of the move to the downside. And therefore, the idea is that we expect price to trade into this and react off of it to the downside, continuing a move that is already in place to the downside by this break of structure. Okay, so this is what we would call a bearish order block. Price is expected to trade into this level and then react off of it to seek lower prices. So if you go into the charts again, study this concept, understand it better, it's one that can help you become more profitable. The second concept on our list will be mitigation block. Okay, this is another concept that is very useful, and I would like to jump into the charts to have a look at it. And this is how a mitigation block looks like. We have a move to the upside, break in structure. Over here you can see these two green candles going to the upside. We have a one candle going down, and then we break structure to the upside, leaving us a mitigation block over here. The idea is almost like what we have already seen with the order block, that after that move to the upside break of structure, we expect price to trade into this mitigation block and react off it to the upside, seeking higher prices or continuing a move that was already in place by this break of structure. And there we have it, a mitigation block. Go further looking into this and see how it can help you in your trading. Now the third concept that we have on our list is fair value gap. All right, so let's have a look how that looks like. Now we have the US 100. The idea of a fair value gap is realized when there is 2 wicks that have left a gap. Over here we have a wick and a wick over here and a body of candle. That leaves us a fair value gap because there was no wicks that traded inside of this gap. It was only a body of a candle. So that leaves us what we call a fair value gap. The idea is the same. We expect price to attract to that level, trade into it, and then react off it to the upside, continuing a move that is already in place. So we see that realize over here, price trading to the upside and then coming back down again into a fair value gap, react off it and move to the upside. Look into this idea further and see your trading transform. Next up on our list, we have what we call liquidity sweep. How a liquidity sweep looks like, it's right here before us on Euro USD. Price trades to the downside, and after trading to the downside, we see it trade into a pool of liquidity. The idea is that on top of this high, we have liquidity, and we want to see price trade into that, take it out and respect it, and begin to trade to the downside. So we wait for that sweep to take place, and after it has taken place, we seek lower prices. So that is idea number 4, liquidity sweep. Let's have a look at the next one. Last but certainly not least on our list, we have what we call a PDRA, premium discount array. And let's have a look at how we would understand these concepts on the chart. Okay, now we are on Euro USD, and this is how this concept would look like. Let me pull out a Fibonacci. And with the Fibonacci, we understand that this range of price over here to the downside, from this move all the way to the downside, is that when price is right below here, we can see that as discount because it has moved to the downside. As far as this range is concerned, we are at discount when price is below this level of 50% over here, the middle equilibrium. When price is below it, we are at discount, and when price is above equilibrium, we are at premium. So what ends up happening is that we understand that when price is below like this, the buyers would rather buy when price is low, and sellers would rather sell when price is high. This is almost like economics and business, because we always want to sell at a higher price in business and buy at a lower price so that we can again sell at a higher price. So anything that is below equilibrium, as far as this range is concerned, in terms of smart money concept, we see that as discounted price. Therefore, it's lower prices. And the idea is, if you buy right there, you go into expect price to trade all the way to premium and begin to sell once it's at premium. And the same thing would apply when it's at discount again. We would look for characteristics that enable us to buy price all the way to premium, again sell when it reaches that level. So that's another concept. Now this concept works, and it depends on which range are you looking at. With that said, this is the end of the video. If you haven't subscribed already, do so. Like, comment also. See you on the next one.